Hello, ladies and gentlemen. I'm Alex Leonida, CIO of Capital Financial Group, and welcome to the Q1 2023 Market Outlook video. We're going to do things just a little bit differently. I always like kind of mixing things up a little bit with these videos. We're going to try some new stuff here. I'm not going to inundate you with quite as much data. We're going to cover some charts to discuss where we were last year and kind of the direction we are going. Then we're going to talk about our positioning a little bit, try to get you out of here in less than 10 minutes, so stay with me. First up is stocks. I want to talk about the indices that we look at here at CFG, in particular, and their performance last year in calendar year 2022. First up, we have the S&P 500. This is 500 of the largest companies here in the United States. That's our purple number on this chart, down about 20% last year. A little bit of a bump into the end of Q4, so that was refreshing to say the least. NASDAQ are our tech stocks here in the United States. Some of the biggest companies are in that group, and there's also a bunch of really garbage, profitless tech companies inside of the NASDAQ as well. But in any event, down a whole heck of a lot, over 30% on the year, and even more than that from its peak back in late 2021. On the international space, we look at the EAFE. That is going to be our light blue here. Both the EAFE and the emerging market index in green both had a major bump at the end of the year. Saw a lot of recovery in that space. The blue one was primarily because of the relatively calm and warm start to the winter months in Europe. And then the green bump was the prospects of China reopening after I don't even know how many months and years of lockdowns for COVID. So essentially what we're going to have in China is we're going to let people get sick. We're going to get some natural immunity. They're going to try to incorporate additional vaccines, but they're going to get back to business as usual. With all the protests and the issues with their economic system, the Chinese Communist Party has to do something. On the bond front, they had a rough year as well, but things stabilized a little bit back in Q4 of 2022. The three indexes or indices that we primarily look at are the U.S. aggregate index, and that's the one in purple here. We have the municipal bond index. Those are all of our tax-free bonds that we like to incorporate in portfolios. And then also we have the global aggregate, which loops in everything else around the world. Pretty weak across the board, but as we discussed ad nauseum, we thought there was potential strength or a downside protection area right around 10 to 15% in the municipal bond market, and it kind of bounced off of that range and stabilized toward the end of the year, even after all the tax loss selling that we saw in taxable accounts. In terms of data, the data doesn't look so great. I think the question here is, how bad are things going to get in 2023? The data was a little mixed in 2022 as the changes from the Fed started to take root a little bit in the economy, but generally what they do at the Fed in terms of interest rates and tightening money supply, etc., those things are slow moving and they have a tendency to take a little while to kick in. So let's look at a few of these data points to kind of dig into things to see how the Fed's policy and our current investment landscape in the economy is starting to shape up. GDP was pretty solid. We don't actually have a chart on that one. We had a couple of quarters of negative growth and a little bounce into the end of the year. This isn't incredibly anomalous in recessionary environments. You have a tendency to see bounces back and forth. But keep in mind, the Fed policy is slow moving in terms of how it's going to play out in individual consumer demand and spending, etc. We are starting to see some of that come out in data. The last shoe to drop will obviously be jobs, and we haven't seen any of that go negative yet. But just in terms of pure data points, and we're not going to do a ton of them, just a few, let's start with M2, and that's essentially just how much money is out there in the universe right now. And when I'm talking money, I'm talking US dollars. So M2, after an enormous spike in the printing presses in 2020, has fallen off the proverbial cliff. We are essentially zero year-over-year money growth. This is the first time in history, at least in the data set that we have. I couldn't find anything quite like this. I mean, it was close in the late 90s, but nothing quite like this. Moving on to retail sales, they were pretty yucky at the end of the year too, although a lot of people probably didn't really notice or feel what was going on in that space. I can tell you that the retailers certainly did. Those companies trying to sell something. I wouldn't be surprised if you saw an inordinate number of emails saying 25% off sale, 30% off sale, 25% off the already on sale items, et cetera, et cetera. That is because we have retail sales slowing a little bit. You can see in this peak here on this chart starting to roll over to the negative. And then we also have business inventories here in the orange, which have been extremely strong. If you consider creating huge inventories a strong data point. Normally what we like to see is for these to track relatively closely, like the first 2/3 or so of this chart. What's going to happen is either inventories have to spike, which they're already at record levels, or we have to see retail sales kind of fall off a cliff, if you will, because something needs to get these things back in line. I think it's going to be the latter, not the former. I would be shocked if inventories climb any further at this point, with the exception of certain things like cars, for instance, where they're still playing a little bit of catch up from demand issues. Consumer debt is at a record high right now. That definitely tightens the old purse strings, if you will. And we have that coupled with consumer savings rates being at record lows. I realize this chart only goes back, 20 some odd years or so. But let me assure you, savings rate around 2% is not normal in the United States. It's only happened a handful of times since World War II. And it seems to be getting worse at an accelerating pace, if that is even possible. Employment data, like I alluded to earlier, is still pretty good. I'm not even going to flash those charts at this point. We're still sitting around that 3.5% mark, and once again, that is one of the laggiest of the lagging indicators. At this point, we don't really expect to see wholesale layoffs across all different spectrums, although we have seen dramatic layoffs, especially in the tech space, as of the last 3 or 4 months or so. That's kind of a canary in the coal mine type of scenario, if you will, as tech companies are the quickest to ramp up and hire, and they're also the quickest to fire to try to save on their proverbial balance sheets. We essentially back-tested all recessions since World War II, and what we're finding is a little bit of overlap. First of all, 2008 seems very, very similar in that people and businesses just over-leveraged themselves a little bit too much, and they took on way too much debt. While this is not effectively identical to the housing bubble we had in 2007, 2008, there are some similarities in the subprime car loan market and revolving consumer debt business as well, where people are just simply over-leveraged, buying things for way too much money, paying way too much interest, and having too high of monthly payments relative to how much their take-home pay actually is. On the corporate front, high growth, really poorly ran companies have a ton of debt coming due in the next couple of years that they were able to finance originally at 3 or 4, maybe 5%, and they simply can't afford to refinance at 10 to 15, maybe even 20%. This is reminiscent to 2000 in that these very companies also are profitless, which is not a great thing. The upside to all of this whole scenario is this is going to purge the system of a lot of garbage that's been floating around, a lot of these meme stocks, a lot of these things that people were jumping in and out of thinking that stock investing was the easiest thing in the world, and that even a monkey could do it, right? You just make tens of thousands of dollars with very little money and very little knowledge. That is all going away, which I think most professionals in the marketplace saw coming a long, long time ago, but it's starting to play out at this point in time. And unfortunately, it's going to affect those that probably can't afford to lose money, but it's all relative, and we'll just have to see how it plays out. In terms of the economic cycle, whenever you have a boom like this, and if we go back to that chart that we just showed about M2 with trillions of dollars being poured into the economy and checks being sent out to people, et cetera, there is going to be a massive boom in overall spending, which improves GDP and is a bit artificial. At this point, we just need a reset, a reversion to the mean, if you will, and the pendulum has a tendency to swing a little too far both ways. So it is our view at this point at CFG that the recession that we already view as starting midpoint last year is going to be relatively long and drawn out, which isn't terrible in terms of overall investment strategy, potential market risk over time. It's just continued flight to quality, strength, balance sheet, dividends, cash flow, etc. Like that is something that we're looking at investing in moving forward. Some of the themes along those same lines this year is we think there's going to be some stability and higher quality investment grade debt, as last year was one of the worst years in recorded history for debt markets, especially investment grade bonds. Second up on the list, we think the high yield credit is going to have a bit of an implosion, if you will. Not a great word to use when you're out there talking to folks, if you're in a sales position. But the bottom line is you have to be mindful of the quality of the investments that you're taking, especially in the fixed income market, with liquidity potentially drying up partway through this year. Emerging markets are looking relatively attractive as there's some semblance of stability, and then also a reopening in China. And then we have the U.S. dollar as a theme. Continued potential strength there as the Federal Reserve allows treasuries to roll off their balance sheet, and then also with that tightening of money supply will continue to raise interest rates, which should give some relative strength to the dollar. We're not expecting anything like we saw over the last 18 months with 10+% increases in dollar strength or anything like that. We just think relatively stable compared to other currencies. And then last on the list for us this year is in the commodity complex. We're looking at precious metals. We did have some exposure last year. They had a fairly strong into the year, and we think that gold and things like that are poised to continue to show relative strength again in 2023. If you'd like to dig into this a little bit more and see how things are impacting your respective portfolios, reach out to our team to schedule an appointment. If you're not a client and you're curious and you'd like a complimentary portfolio review, send us an email over at info@cfgfinancialplanning.com. And if you like these videos and they're helpful and you would like to subscribe, we would appreciate it. Don't forget to hit that like button at the bottom of the screen as well. And here's to a blessed, happy, and safe 2023. Thank you all.